All right, let's dive right into this. Welcome to this explainer. Today, we're doing something really exciting. We are putting Curtiss-Wright's real-world financial data through the absolute ultimate gauntlet of legendary investing frameworks. Think of me as your personal, expert investment analyst for this session. We're going to apply the exact methods of Warren Buffett, Peter Lynch, Benjamin Graham, and even run a modern DCF model, just to see what the stock is truly worth under the hood.
Here's the quick game plan for our valuation lab today. First, a company snapshot. Then, we look through the Buffett lens, followed by the Lynch lens and the Graham lens. After that, we'll run the DCF and alternative models. And finally, bring it all together for a final verdict.
Okay, Section 1. Let's get a snapshot of exactly what we're dealing with here.
What is truly fascinating right out of the gate is the sheer scale and, honestly, the massive premium of this company. So Curtiss-Wright, trading on the New York Stock Exchange under the ticker CW, is an absolute powerhouse in aerospace, defense, and commercial nuclear energy. With the stock price surging lately into the $719 to $765 range, they command a market cap of practically $27 billion. But here is the real kicker, guys. They're trading at a steep price-to-earnings ratio of almost 56. You gotta ask yourself, why on earth would anyone pay that kind of premium?
Well, that massive premium might just be justified by their 2026 financial guidance. They're boasting operating margins expanding to over 19%, alongside an incredibly impressive EPS growth of 13 to 16%. I mean, they are highly profitable and they're growing fast. And you know, that sets the absolute perfect stage for our first guru analysis.
Section 2. Let's look at this through the eyes of the oracle himself, Warren Buffett.
So looking through Buffett's lens, what does he want? He wants a deep economic moat, consistent earnings, high return on equity, manageable debt, and of course, a good price. And honestly, Curtiss-Wright passes the qualitative test with flying colors. They have a massive economic moat heavily rooted in highly regulated submarine and nuclear tech. It's tough to compete with that. They also deliver incredibly consistent earnings, showing over a 15% EPS compound annual growth rate since 2023. We calculate a rock-solid 16.5% return on equity. That's based on their 2024 net income of $405 million against $2.45 billion in total equity. Oh, and their debt? Highly manageable.
But to calculate Buffett's intrinsic value, we have to look at owner earnings. Taking their 2026 free cash flow guidance midpoint of $595 million as a proxy for owner earnings, the Buffett verdict is crystal clear. This is a wonderful company. However, and it's a big however, Buffett famously demands a margin of safety. He usually wants a 20 to 30% discount below intrinsic value. At a nearly $27 billion price tag, yeah, Buffett wouldn't touch this without a significant price drop to widen that margin.
Moving right along to Section 3, the Peter Lynch lens.
Now, Peter Lynch loves to categorize companies before he even starts crunching the numbers. He looks closely at growth rates, balance sheet strength, and insider activity. He'd probably place Curtiss-Wright right on the border between a reliable stalwart and a fast grower. A stalwart is your typical large, established company that grows steadily. But Curtiss-Wright's impressive 15% growth rate, that pushes it right up into the fast grower territory that Lynch absolutely loved to hunt in.
But then we calculate the PEG ratio. That's the PE ratio divided by the growth rate. And well, this gives us some serious pause. If we divide that 56 PE by our 15% growth assumption, we get a PEG ratio of 3.73. That is way above Lynch's ideal target of 1.0, which would indicate fair value. Now, Lynch would definitely appreciate management's $160 million share buyback program. That's always a great sign of financial strength, but the valuation here would make this a pretty strict hold at best in his book.
Section 4. Time for the Benjamin Graham lens.
It's time to get strictly mathematical. We're talking about the father of value investing himself, Benjamin Graham. Graham doesn't care about your company's story. He cares about hard numbers, a strict defensive checklist, and a deep margin of safety. Running through his defensive investor checklist, Curtiss-Wright easily passes the adequate size and earning stability tests. I mean, they boast a 50-year dividend record, but they just utterly fail his requirement for moderate valuation multiples. Graham wanted cheap stocks, and frankly, this stock is priced for perfection.
Let's do the math. Deriving a roughly $70.28 book value per share from their $2.45 billion in total equity, we plug the numbers into his famous formula. We take the square root of 22.5 times their $15.25 EPS times a 70.28 book value per share, and it spits out an intrinsic value of about $155.28. With the stock trading over $700, there is a massive negative margin of safety here.
Graham wouldn't just avoid the stock, actually scratch that, he'd probably run the other way as fast as possible.
Section 5. Let's look at DCF and alternative valuations.
Okay, stepping into modern intrinsic valuation, we can build a base case discounted cash flow model. We'll start with that $595 million free cash flow guidance. We're assuming strong cash flows for the forecasted years, which is heavily driven by rising defense budgets and those commercial nuclear tailwinds we talked about. This is where we get to act like a modern Wall Street analyst.
Now, because the weighted average cost of capital, or WACC, isn't explicitly provided in our source data, we have to make an educated assumption to fill the gap. We're going to assume a standard 8.5% WACC for an established defense contractor, and we'll pair that with a 3% terminal growth rate to reflect perpetual inflation and general GDP growth. Running this sensitivity analysis helps us triangulate a modern fair value per share, and guess what? It lands significantly lower than a 56 PE implies. It usually comes out closer to the $300 to $400 range.
Looking at alternative models gives us even more context here. If we apply standard defense sector comparables for PE and EV to EBITDA multiples, which historically hover around 20 to 25 times earnings, it yields a target of around $375. So again, still well below the current trading price.
Section 6. The synthesis and final verdict. Let's bring it all home.
Bringing all of these frameworks together reveals a really vivid tension in our analysis. It's like a tug of war. The qualitative models, like Buffett's, recognize a truly incredible moat-heavy business with absolutely fantastic margins. But the strict quantitative models, like Graham's, alongside our modern DCF and comparable models, they highlight severe overvaluation at current levels.
The core insight you should take away from this is that while the operational strengths are completely undeniable, we are literally talking about record free cash flow conversion and operating margins expanding to over 19%. The primary risk is simply the sky-high price tag you're paying for that excellence. A nearly 56 PE leaves zero room for error. Everything has to go perfectly.
So what does this all mean? Ultimately, our blended recommendation makes this a solid hold for current owners, simply because the underlying business quality is so spectacular. But for new money, it's a pass. To trigger a buy, Buffett might want a price closer to $400. Lynch might want the peg to drop, implying a price around $350. And Graham, well, he'd stubbornly wait for a massive crash below $150. It just goes to show, a phenomenal company isn't always a great stock if the price isn't right. So knowing all this, at what price drop would you finally pull the trigger and buy?